Hey guys, Stefan here. So this is the Bitcoin weekly update. So this week I wanted to take more of an investment view as we had some articles that came out that really help emphasize Bitcoin is growing up from and it's starting to be seen more as a fully fledged investment. First of all, I'll start with some of the intro statistics. So we've got about 10,000 full nodes. Bitcoin's network usage of SegWit is around 35%. On the Lightning Network, we've got 2,473 visible nodes, just under 8,000 channels, and about 24 BTC in terms of capacity on the Lightning Network. We've got about 17,097,000 Bitcoins that have been mined, and in terms of the long-term returns, you're looking at, for 2 years, 758%. For 5 years, you're looking at 6,438% return. The Mayer multiple. So the Mayer multiple is sitting at 0.64, and with the price around 6,500 US, the multiple has been higher than this point historically 94% of the time. So on a historical basis, it's probably a good time to be buying more. So into some of the articles. So first up, we've got Pierre Rochard's Bitcoin Investment Thesis, Part 1. So Pierre is one of the world's top Bitcoin maximalists, and he was one of the guys who was writing some of those articles back in 2013 and 14 that really helped shape the view of Bitcoin viewed from an Austrian economics point of view. So nowadays he is more of a software developer, but he's also running Bitcoin Advisory, which is a bit of an investment advisory firm on Bitcoin. So what he does in this article is really good because he's basically categorizing some of the different cases for investment using different axes or ways of looking at it. And so in this graph he's got here, it's the axes of holding period and then the adoption potential, as in how many people could use it for that particular case, and how long would they be looking to hold Bitcoin on that particular case. So the focus here is on reasons that would cause an investor to hold, and that's important because holding is what, people having a desire to hold is what makes that currency or that asset have value. And the other really cool thing that Pierre does is that he shows both the positive thesis and the antithesis for each particular case. And so there's a real effort to steel man both sides, and steel manning in this case means to present sort of the best arguments of both sides, rather than sort of saying, oh, well, here's my best argument against your worst argument, which is a really good sort of intellectually honest thing to do. The other thing that he does as part of this article is it helps dispel this false notion that Bitcoin is all about drug dealers and criminals, that there is a legitimate investment case. So some of the cases that Pierre lists out include things like retail payments and the fact that there's no chargebacks with Bitcoin. He also talks about micropayments, this concept of using very, very small payments to maybe pay just to see one article or pay to interact with some online game, things like that. You've got other examples of international remittance, online gambling, unbanked businesses who find it hard to get a standard bank account but are able to use Bitcoin for that to run their business. You've got examples of routing around capital controls imposed by governments of the world. And we've also got this concept of the vehicle currency, where people trying to trade amongst amongst foreign exchange markets that are not very liquid in a direct sense, but maybe they've both got a liquid market in terms of Bitcoin, can use Bitcoin as their vehicle currency. So there's some of the examples. I'm quite excited to see what's coming in part 2. And the other cool thing is that part 1 of this article is looking at sections A and B, which are relating to the shorter holding period. Whereas from my point of view, I care more about the longer term thesis of Bitcoin. And this is where the more powerful use cases and investment theses will come from, in my view. And some of this is what you would have seen popularized by Saifedean Ammous in his book, The Bitcoin Standard, and some of his speeches, where what is really important is the stock to flow ratio of Bitcoin versus other potential monies. So next up, we've got Grayscale's research that they've put out, and it's called A New Frontier. So it's a research paper by Matthew Beck. and so they are basically a digital currency group company, and they offer various investment trusts and funds, and they've done some research and publications. So the basic thrust of this article is that Bitcoin and digital currencies are a brand new asset class, and they help investors achieve a better risk-adjusted return. And so part of this is going back to those old finance classes that you might have gone through at uni, or if you haven't done finance, it's this modern portfolio theory. So it's this concept of the efficient frontier. So you can see this graph, and basically the concept is, given your investments, they would have a certain return or reward, and they have a certain level of risk, which is like the volatility. And by combining the assets or the investments in a certain way, you sort of end up plotting yourself somewhere on this graph. And generally the idea is that for any given level of risk, you want to try to be getting the maximum level of reward for that given level of risk. Otherwise, you're just taking risk unnecessarily. So the argument here is that with Bitcoin as a new asset class, it can raise that potential frontier, and that's hence the name of the article, A New Frontier. And it's basically saying that rather than accepting where we are in the world on that plotted on that curve, actually we can go higher than that and get even more return in a way where we're getting enough return to compensate for the risk associated with it. So what's the impact then of asset correlations? So that there's a discussion here in this paper on that as well, talking about how the idea is you want uncorrelated assets, so that when one asset is zigging, the other one is zagging. And that's one of the famous saying is something like, there's only one free lunch in investing, and that's diversification. So this is again part of that argument that with a reduced correlation, you're getting more of a benefit from diversifying. And then this next section here is the really interesting stuff, because they're talking about what is the simulated portfolio performance. So they take just a standard sort of global 60-40 stocks and bonds kind of typical portfolio that someone might hold, and then they add just a 1% Bitcoin allocation, or a 3 or a 5% allocation, and then they show, well, actually you could have gotten this much more return without necessarily increasing the overall volatility, and so you're getting much better risk-adjusted return. So one of the key concepts here is the Sharpe ratio, and you can look it up if you want the details of it, but the gist of it is basically it characterizes how well the return of an asset compensates the investor for the risk taken. So, and I think this is something that a lot of early Bitcoiners sort of sensed intuitively. They might not have known about the Sharpe ratio and so on, but they probably sensed that, well, this is kind of like a lotto ticket bet. I can just put in a small amount back in, in the first, 8-9 years before this whole thing has blown up over the last year or two, and it's just a small little bet, but with a massive payoff chance. So it's just a very worthwhile bet to take, is the thinking around it. And so I think, just to summarize in terms of this article, I think we're now seeing a popularization of this concept that people should put 1 to 5% of their portfolio into digital currencies, and in my view, that's just Bitcoin, basically. So I think this is what we're going to start seeing: family offices of high net worth individuals and some investment managers coming into the space and doing that. And when you think about how small Bitcoin is compared to the rest of the world, right? The total market cap, as I make this video today, for Bitcoin is around maybe 130 billion or so. When we're talking about multi-trillion markets around the world. So, as I've mentioned before, the global market for wealth is around 280 trillion. And, the global markets for stocks and bonds, we're talking dozens or 100 trillion, in that range. So what happens when this ocean of money tries to come into this tiny little, drop in the ocean, so to speak, which is Bitcoin? Well, that's going to mean massive gain potential to come from Bitcoin over the long run, so long as you're willing to take the volatility that comes with it. But as we've sort of outlined in this article, that maybe that return is worth that risk based on the Sharpe ratio and done in the right way where it's diversified. So another great article, well worth a look, and I'll put the link in the description as always. So next up we've got this article, The Truth About Smart Contracts by Jimmy Song. Jimmy Song is a well-known educator, programmer, has contributed to Bitcoin Core in the past, and now works more as a bit of a VC investor, but also really plays a big role in the community as an educator. And I really like this article by Jimmy because he really is pouring cold water on the Ether huffers, because there's a lot of false promises being sold by Ethereum and a lot of these other blockchain tokens and startups, where basically they're overselling this promise of smart contracts, this concept that there's going to be the smart contract that will enforce everything impartially, and that it'll take away the middleman of lawyers, and that there's going to be this massive gain to society. But the reality is it's not that simple, and it's just not feasible for many reasons. So there are problems just straight up at the start. You can't, it's not that easy to encode all of this sort of judgment and skill around, you know, knowing the case history and law and the common law and so on. It's not that easy to code all of that explicitly into some kind of software, right? And then the other component is he points out that there are problems introduced by having a Turing complete language, that you can't easily enumerate and evaluate how that program and scripting will work in terms of the computational cost versus compared to the non-Turing complete languages such as Script within Bitcoin, where it is easier to sort of enumerate and evaluate what is the computational cost of this particular script. So the other thing is it ties back into the real world. So smart contracts, they only work with digital bearer assets. Trying to tie back against the real world all of a sudden creates an Oracle problem. Now you're trusting a third party to verify the events that have taken place in the physical world. And there is a risk then that somebody tries to hack or influence that third party to change the judgment such that you can then get the desired outcome on your smart contract. So, they might be bribed, they might be hacked. There's all sorts of problems that it raises. So it's just not that simple. So I think I like this particular segment here by Jimmy. It says, instead of getting machine-only execution and simplified enforcement, what you actually get is the complexity of having to encode all possible outcomes with the subjectivity and risk of human judgment. In other words, by making a contract smart, you've drastically made it more complex to write while still having to trust someone. So that's some pretty devastating commentary there by Jimmy. I think in a nutshell, you could say it's just too easy to screw up, it's too difficult to secure, it's too hard to make trustless, and there's too many external dependencies. Smart contracts are just not all that. And we're seeing examples now of smart contracts failing and people losing a lot of money because of some error in the code. So smart contracts, you should be skeptical. So for today, we've gone through some of the investment theses concepts around Bitcoin and also the new frontier that Bitcoin represents from an investment point of view. Also, we've spoken about why we should be skeptical on smart contracts. So if you found that useful, please give me a like, please share the video and subscribe to the channel. Otherwise, give me any feedback on Twitter @Stefan Livera. Thanks guys, see ya.